Today, we're looking at two bets David Tepper of Appaloosa made last year. Joining us now is Bloomberg's Sally Bakewell, who leads the team covering finance in the America. So one worked, one didn't. Walk us through it.
Okay, so hedge fund returns annually continue to roll in to varying degrees of pleasure and varying degrees of pain. And we've seen both of those this morning already. David Tepper's Appaloosa Management had a good hedge fund payday. It eked out returns of about 20% because it loaded up on tech ahead of the AI boom. And it also helped push Tepper's fortune to about 19 billion. The other trade didn't go so well. He is the owner of the Carolina Panthers, and his sort of bet on the player Bryce Young hasn't paid off quite so well with its league worst 2-game win.
A little fine emanating from his reaction to that lack of performance.
That's right. He articulated his frustration.
Probably pales into comparison. Which he was fined for. But I guess that pales into comparison with some of the gains. Saeed Haidar, what went wrong?
That's right. So Saeed Haidar, his Jupiter fund lost 43.5% last year. He made bets on, and he's a macro trader known for his stunning gains and also his stunning losses, and he made short bets on government bonds, which appeared to have somewhat backfired last year as the regional banking turmoil and the kind of continuing inflation running hot forced traders to recalibrate some of their bets on the direction of interest rates and on the economy. Now, Haidar, in fact, was one of the bigger losers during the regional banking turmoil. In the month of March, when Silicon Valley Bank collapsed, it actually lost 32%, which was its worst monthly loss. And that has overall the situation has forced it to retool its portfolio, reversing its short bets in favor of longer wages, as Haidar expects that global central banks will reduce interest rates.
Okay, Sally, so we've talked about Tepper, we've talked about Haidar. Zoom out. Who have been some of the other big winners and losers that we've heard from thus far?
Well, it's been quite a challenging year for the macro traders like Haidar because they seek to profit by analyzing economic data like GDP, unemployment and inflation. And they've, of course, last year had to wrestle with the pace and extent of interest rate hikes and trying to time the sort of policy pivot. But they didn't all do badly. Discovery was up about 48% last year on sort of emerging market stocks, bonds and stocks. And Alphadyne was up about 17%. Unfortunately, Bridgewater, however, had a slightly worse year and was down about...
Alpha, baby.
Right, and it was down about 8%, unlikely on wrong way bets on stocks and bonds.
So what is looking ahead to the kind of year that people expect? Rate cuts coming through, we don't know quite when. I've been hearing quite big ranges in terms of how the 10-year might trade. What does the setup look like for these funds?
Well, with the much anticipated rate cuts around the world, this, of course, creates a lot of volatility in the markets, in the equity markets, and with volatility often comes opportunity. So they're probably going to see a lot of opportunities there. Now, the hedge fund industry has surpassed $4 trillion now, and it's expected to continue to grow. But a lot of the money is ending up in the bigger shops, and so the bigger shops are likely to get bigger. There are concerns around multi-strat funds, by the way, too, which had a sort of middle-of-the-road year this year. We saw funds like Citadel, which posted a 15% gain, and Millennium, which posted a 10% gain, which was decent, but they have had better. And so there are concerns about that space that they might sort of be over-leveraged and overcrowding.